And we are live. Rob, good to see you.
Good to see you. Good to see you.
We get to break bread Sunday night in person with our good friend Anita Padilla.
Yeah,
Fun.
at
So,
the at Acuma.
yep, yep. Looking forward to that. So,
Acuma has really gained in traction in recent
Hey
years in
guys.
terms of
Jennifer, what's going on? Jennifer coming in hot right off a panel at
I
the new.
literally just left the Servicers Playbook 2-hour roundtable, and
Wow.
they were kind enough to let me sit in this room that they have for the comp for the MBA, and to do this. But hi, everybody! Yeah, you definitely got live at the conference.
Yeah, we're already live, so we're just throwing you right into the frying pan here. But I love it. Thanks for accommodating us off your speaking appearance, and good to see you.
Yeah, no, good to see you guys too. Thanks for the invite. Looking forward to having a discussion. Special week this week. I think lots to discuss.
It's no shortage of topics. I can't wait to get.
first of all,
Absolutely,
do you go by Jennifer or Jen?
Jen.
Jen. Okay. All right. Good to know.
Awesome.
Rich, we appreciate you dressing up for today's show.
Thank you. I've been having to dress up for actual travel, so I'm slumming it out today in the Buckeye gear. So, but all right, let's go
What,
ahead.
what,
Go ahead,
no, I'm
Rob.
not done yet, Rich. I'm not done. When's the last time you actually put on a necktie?
Who? God, it's been a while. It's been a
Pre-COVID?
Yeah, you probably, yeah. When I was at TMC, I kind of, it was a more casual org. I would wear, sport coat, dress shirt, no tie typically, but the necktie, it's been a while. Rob, when's the last time you wore it? Oh wait, you have one on right now. So there you go.
Uh, as you might recall, Rich, I think in the early days of this show, I would wear a necktie every show, whether
Yeah.
I was just sitting at home in uh, in my boxers, I would
Hmm.
still have a necktie on. But today I'm in Vancouver, Washington, just across the river from Portland, Oregon, and at a Banner Bank event.
I do remember that. Yeah, there was often a source of humor on the show. Me making fun of your neckties and you being assaulted by drug dogs while traveling. I remember a lot of funny show humor related to those topics.
That was a sorry, Jen. We got a trip down memory
You're
lane here
fine.
just for a minute. But Rich, that particular show, I remember a couple very memorable shows and animal exposure early on. But the drug dog event took place at the Little Rock Airport after a storm came through, and I was speaking at a private company event, and I got to the airport, and it was deserted. And after they'd had about a half an inch of snow in Little Rock, and I thought, uh-oh. And so I proceeded to spend 2 or 3 days there until things thawed out and the airport opened back up. But I was at the Little Rock Airport doing this show, and literally a drug sniffing dog did give me the once or twice over. So,
I remember that. Yeah, it became a fairly regular occurrence, and yeah, you were
well,
you
and
would
with
you
good
would
reason,
often
Rich, with good
jump
reason.
on from just random, like mystery locations outside of prison. I remember once there was one time you were in a pub in Alaska.
Yeah, yeah.
So some good
Yeah,
shit.
Northwest, Hawaii, Alaska.
Mm.
It's a big nation out there. And you've done the show from some tiki shack in Florida, as I recall, at one
I
point.
did. I did. So good stuff. All right, let's go ahead and get into it. This is the big picture. My name is Rich Swerbinsky. I am with Onward and Upward Consulting, also the executive director of the Ohio Mortgage Bankers Association, and joined, as always, my esteemed colleague and co-host, Rob Chrisman. Rob, great to see you.
Yeah.
The show is sponsored by our great friends and sponsors at Depth. Industry trailblazer Kerry Milam nearly 20 years ago founded Depth, and now run today by her fantastic EVPs, Leslie and Lindsay, who I got to spend some time with this week at the TMC conference. Outstanding. And yeah, if you are a fintech that needs your story told, Depth is the company to do it, and they will do it fast for you because the fintech space moves fast, and you need a partner, communications partner that can accommodate it. So depthpr.com if you need more info, or hit up Rob or I, or you can find Leslie, Lindsay, Carrie, all on LinkedIn. So good stuff. Today, we are very, very pleased to be joined by special guest Jen McGuinness from Pivot Financial, coming in hot off a speaking appearance at the NEMBA. Jen, thank you for joining us, and great to have you on the show.
Thanks for having me, guys. I appreciate it. It's been a busy day, but I'm, as you said, coming in hot. What are we going to talk about today,
You're
Rich?
ready to talk. You've been talking for 2 hours.
Absolutely.
This should be good. And as always, chat, keep it lively. Jen, for our viewers and listeners that may not know you in the industry, tell us a little bit about Pivot Financial and what you do for clients.
So, Pivot Financial has two channels to it. One, we're a correspondent aggregator for new loans, all non-agency. So, first lien non-QM, first and second lien HELOC, DSCR, bridge, fix and flip, and ground up construction. But we're also an asset manager, due diligence, loss mitigation, optimization, breach and repurchase defense, and also litigation support. So it sounds like a lot of verticals, but it's not. It's really just the life cycle of the mortgage loan. And, when I started this business, that's exactly what I wanted to build. I got sick of building multi-billion dollar trades. We now have a full life cycle company, and I think that's a really special thing.
Love it. Love it. Love it. And yeah, excited to get your perspective on all the latest and greatest in the wonderful world of mortgage as we get into the show today. So thanks for joining us, Jen.
Absolutely.
So litigation support. Have you ever done expert witness work?
I have not personally been the expert witness, but yes, our firm has done expert witness work, and we still do. Recently, I have been asked if I would be the expert witness, and it's something we're considering as well.
It's not,
It's
it's not,
a I've done expert witness work, and it's although it's lucrative, it is very taxing on one's system. It's unusual to sit across from somebody whose entire job is to discredit you and find fault with everything that comes out of your mouth. Uh,
Well, even in litigation support, right? Even if you're not doing that, as a witness in a court, it's kind of the same thing. The other thing I would say is, Rob, I was asked during the housing crisis to be an expert witness, and they wanted to pay millions of dollars, and the answer was that's not enough money to end my career. You know what I mean? So it is something that you need to, not take lightly, for sure.
yeah.
good stuff. Excited to get into all that and more. Rob, we start with the big picture news in the mortgage industry.
Hang on, Rich. I'm not done. We're not done talking about Jen yet.
Okay.
Jen, where do you actually live?
So I'm based out of Michigan, and actually our main office is also in well, I don't live in Ann Arbor. I live in Brighton, Michigan, but our office is in Ann Arbor, and we also have one in Dallas, Texas.
And it's autumn there, or the leaves turning?
They're starting to get a little bit of color, but it's definitely not fall yet. But fall is my favorite season, so I can't wait until I have my rainbow of leaves. That was actually probably the hardest thing when I lived in Texas after leaving New York, Rob. They don't really have fall. It's green, yellow, and dead leaves. It's not colorful in any way. So fall is my thing. So we're almost there.
Yeah. I've been told that I should go to upstate Michigan. In fact, the MMLA event is next year, October 4th, 6th. You'll find me there. But part of Joanne Mizraka's bait to get me to attend was, oh, it's a great time to visit upstate Michigan, and there's a famous highway where it's very scenic. So I
It's
may
called
just
the
do that.
Tunnel of Trees. Yep, it's called the Tunnel of Trees. It actually is very famous, and but you got to time it exactly right, or it doesn't make sense to go, right? So the leaves are only there for a short while. So, and it changes each year. So definitely see if it's gonna, coincide with when you're going.
Okay. We've Jen, I appreciate you being here because normally at this point we're talking about some arcane college football, result from a week ago. Rich's team would have, whatever. So nice to talk about Mother Nature instead of the gridiron. So thank you.
Yep, absolutely.
All right, Rich, we're done now. Go ahead.
So the headlines this week, Rob. Of course, the Fed meeting this week, they lowered 25 basis points,
What a surprise. What a surprise.
as most expected, and also as expected, muted market reaction. Not too much of anything, as that obviously was kind of already priced into the market. You got the Trump Lisa Cook thing still going on. Trump now trying to take it to the Supreme Court. UWM, the first to move on a new conforming loan amount, which was interesting, caught my attention.
It
819K. I think up from like, what is it now? 807 or something.
was
Some
806. Yeah.
806. So first ones to move there, which raised some eyebrows as, many anticipate the GSE's shrinking footprint potentially a little bit as they move towards some sort of public offering. So, and then my guy Scott Bessent basically admits to, trying to punch or wanting to punch Bill Pulte by invoking the Hamilton Burr duel. When asked about it, you sent me this column, Rob. I love Besant, and I found this hysterical that you alluded to the Hamilton Burr duel, where Burr was killed, actually, I believe, in a duel with the Treasury Secretary back in the late
Yeah.
1800s.
Yeah. Aaron Burr was not the one
That
who
is
ended
true.
up on the $10 bill.
Yeah. So
That was
you're
Alex.
100% right. Burr was killed. So interesting visual there, to say the least, right?
Rich, speaking about Besant, he's going to probably be my lead paragraph tomorrow because he too apparently has a couple owner-occupied houses to his name.
Okay. And Rob, the chat asking if you were at the Hamilton Burr duel in person. It was the
So
Jen, let's go back to Autumn. Are you a Starbucks pumpkin spice latte gal or?
no, I'm not a fan of the flavored syrup. Now, if you bring me something with real pumpkin in it, I'm all about it, right? But the
Okay, good.
nobody get mad at me. The chemical version of pumpkin is not my jam.
Yeah, I've talked to people who've made pumpkin pies from real pumpkins, the sugar pumpkins. It's a lot of work. I just go with the Libby's.
Yep, nope. I think I do too for my pumpkin pie.
Yeah. Sorry, Rich. Go ahead. What were you saying about
Uh,
Scott Besson and having two owner-occupied homes?
Well, as usual, I toss all that to you, to see which way you get us started. So,
And
I think
yeah,
the Fed, as expected, did what lowered a quarter. Banks have lowered the prime rate. I think psychologically the impact is good. As usual, the bond market had that priced in. I think the bond market, reacts to current events much more quickly than the Federal Reserve, which meets every 6 weeks or so. And so the bond prices, 10-year Treasury prices, and so on, had already moved. Um, the one member of the Fed, the new member of the Federal Reserve, who, as I mentioned today, is actually employed by the White House. He dissented and wanted a 50 basis point cut, which I think would be aggressive. But the future rate cuts are pretty much expected at this point as we wind our way back down toward lower overnight rates, as it were. So, but we'll see what the bond market does. I think the bond market, the 10-year yields shot up initially and they've come down a little bit. Everyone's waiting for them to drop into the threes, which would be nice. And I'm at this event where there are a lot of originators asking me, what's going to happen next? What's going to happen next? It's always, the news comes out and then, all right, what's next? All right, CPI did this. Well, next week we've got PPI, and what's that going to do? And then we've got unemployment after that, and what's that going to do? And so there's always something in the future to look forward to in terms of economic news. I think that the inflation is what it is. It's the Federal Reserve and practically everybody. It seems like they don't tend to look at the inflation numbers all much anymore. I mean, some, but not quite as much. And it's all about employment and the softening labor market. And then you've got people out there asking, well, why is the economy slowing down? Uh, why is unemployment creeping up? Is it the tariffs? Is it the economic policies? And so time will tell, but certainly things are slowing a little bit and rates are expected to continue to drop a little bit. So not a
Can
bad
I
thing.
throw something in here just to add to that chat, if you don't mind, Rob?
Not at all.
So a couple things. Brian Levy, you're 100% right. It's actually that Burr killed Hamilton. He shot him in the abdomen. So we misspoke earlier. So I
Whoops.
apologize. But what I'd like
Brian
to say
Levy's on
is,
here. I can't see
yeah,
the screen. Brian,
yeah.
I just saw
So
Brian speak.
yeah. So another thing, everybody is going crazy over this release of, 900,000 plus jobs with the Bureau of Labor Statistics, right? But what's amazed me is that nobody's spoken about the fact that this happens every year. In September, every year, there is the true up of what's been reported, as it pertains to employment. And last year in 2024, for example, their revision was 818,000. And this happens every year, but nobody is taking the time because they like the headline, and it's being used a lot in Washington as well, to talk about that. So I think, context is important. So I think we should talk about that a little bit more. And to your point, the Fed governor, they're very focused on Cook. Well, what about the other two Fed governors that are still sitting on the Federal Reserve Board that were also appointed by Trump? They actually agreed with 25 basis points and did not push for 50 as well. So at this point for this meeting, after all of the noise surrounding it, you had three technical Trump appointees, right? Sitting in these meetings this time, and there was only one dissent. So I think that's important as well. So, and I'm not going to tell you my opinions one way or the other on this with regard to Powell, but he clearly he's done the work to have the conversations, because if it was really just a political vote, I think you would have seen something very different here. And I think that should be brought up as well.
Yeah, I like to think that the Federal Reserve will or is independent of politics and will remain independent of politics. I haven't actually looked to see who has appointed which president has appointed and the Senate confirmed, right? The members of the Federal Reserve. The I know we had the one resign about a month or two ago. And so we have a situation where I think that if you ask any bond trader or any investor, they like the independence of the Federal Reserve, or at least the perceived independence of the Federal Reserve. The Every president, of course, wants low rates because that helps spur the economy and drive down unemployment. Um, and so, yeah, getting back to your earlier point about, yeah, it seems like every year it's like, oh, another 800,000 jobs that we don't have that we thought we did, or now it's 900,000 or whatever it might
Right.
be. It is a curious thing. And I was watching, I knew when it was coming out, and I watched the market reaction, which was like negligible. It was like, oh well, we knew it was going to be, hundreds of thousands, so we're not going to react, just the way it is. Maybe that will change next year. Now that we have a new BLS person there. But yeah, it is curious how the market just shrugged off that news, and
Yep.
it indicates something Rich has been saying all along, which is uh, Ohio, the Buckeyes are the best team ever. No, I'm just kidding. That the economy is, or at least the labor market isn't strong, and certainly it's an interesting economy from a labor perspective because you have this shift, and it seems like they talk about the gig economy and Uber drivers. And when you talk to an Uber driver or a Lyft driver, oftentimes it's their second job or their third job, or kind of a part-time thing that they're doing while they're waiting for something else to happen. It's interesting hearing their story. And I would think that it's confusing to anybody who is typically in the government looking at labor. Is somebody employed? Well, is that Uber driver employed or Lyft driver employed? If it's just a part-time job, if it's a second job, how do we count that? And
Mhm.
it seems like it's a tale of two economies as well, because the lower lower layer, I'd say, is in an entirely different situation than the upper strata, as it were. So, and you need that lower income base to drive the economy, I think, and that's suffering right now.
Yeah, and I think there's a lot of things that could, in theory or reality, be done better. I mean, even in CPI, they don't use mortgage data, they use an estimated rent for homes, right? And they changed that years ago. And the fact that they're using what would be the possible estimated rent for the homes that are actually owner occupied, owned residences is wrong too, right? Same thing with, housing starts and a few other things that really, if they were refined, I think we'd be seeing different things.
Yeah, this is been a huge issue for me for so long. Just the way that we collect labor and, consumer purchase data in America. It's been the same way for many, many decades, and just really feels like in this day and age where we're watching technology do things every single day, something new that just blows my mind that we still have such antiquated methods to collect this important data. Jen, a couple questions. One, you mentioned, this year's revision was huge. Last year's revision was also huge. I don't remember like the history of this annual revision. It feels like the revisions are getting bigger every year, but I don't know if you or Rob know, like,
If you go back, yeah, I mean, if you go back, the revisions have been sizable for a long time. I also think this year, when you think about $100,000 gap, I also think you have to think about what's different this year than last year. As an example, to have 100 plus thousand dollar deviation, not dollar, excuse me, count deviation. And, there are other things at work here. There are employed people, for example, and this is not a political statement, it's just factual, that are being deported. There's a lot of movements that were not occurring, previously, with possible employment as well, that have to be taken into consideration. And, if I were running something that was responsible for reporting labor statistics, I'd be breaking out and teasing out that data to really understand, the up and downstream impact of all the different things that are happening that could be impacting CPI, the Bureau of Labor Statistic, employment data, et cetera. And I think, that's important and it needs to be talked about. There's a lot to learn there.
I agree. Jen, how's the vibe, the mood at the New England Mortgage Bankers Association conference?
Actually, yeah. I mean, the vibe here is actually great. In full transparency, I've never been to this conference before. I was invited to take part in a couple conversations this year. And, candidly, I actually like going to some of the smaller, there's hundreds of people here. And I really do like going to some of the smaller conferences. I think, speakers sometimes are a little bit more transparent, less scripted. I think there's a lot of more, Q&A and interactivity. Pivot sponsored the Servicers Playbook, which was a 2-hour roundtable experience here. And one of the things that I wanted was to open it up to the audience and let them ask the things that are on their minds. And, the attendees are, for example, everything from the investor to the independent mortgage banker to the credit union, the bank, the small to mid-sized lender, the QSO, et cetera. And we did have a dynamic conversation. I think that's important as well. And yesterday, I was asked to take part in thinking outside the GSE box conversation, and talking about that as well. And good dynamic conversations here. So I'd say the vibe here is really good. It's been an efficient use of time for sure.
I think something Rich and I have talked about, and I continue to hear evidence of it. When you talk about the GSEs, when you talk about thinking outside the GSE box, well, certainly non-QM has gone through an evolution, and now it's whether, and I won't single out non-QM, but non-agency loans, whether they're non-QM or jumbo bond programs, whatever they might be,
Mhm.
they have taken market share away from Fannie Mae and Freddie Mac, and with good reason, whether it's underwriting or the ease of doing the loan, private label securities, private money lending. There's a lot of that going on. And I continue to tell audiences, it seems like Fannie Mae and Freddie Mac are going 10 miles an hour in the fast lane. And it wouldn't be that difficult to make some changes to the agencies, but they don't seem to be jumping in. They're not, you don't see them lowering their G fees, for example, which would help them regain market share. Do you get the impression, Jen, that Fannie Mae and Freddie Mac are just kind of watching the world go by, or are they intentionally, decreasing their footprint in the overall lending world?
Well, we actually analyze that a lot, right? And the reality is they are decreasing their footprint. They are also watching things, but I think that, you know, um, they're very important. Why? Non-QM, for example, so call it non-agency. Okay, the number went from 1% market share to 8% of all loans originated in the last 5 years, for example. But what does that tell you? 92% generally of mortgages that are being originated are Fannie, Freddie, FHA, VA, a little bit of USDA here and there, right? That's a big deal. And that's without business purpose loans, right? So, if you think about where's this mortgage market been stuck for, call it a while, 2015, and then again, COVID, et cetera, it is stuck. And I think in our experience, especially, on the breach defense side and certain other aspects of our business, they've become less business partners and more business legislators to a lot of their client base. And, I would like to see the market collaboration that existed previously. And I also think that there, not only them, but even some of the largest aggregators are forgetting where these loans come from, right? 83% of loans originated last year were originated by independent mortgage bankers. If you look at Fannie, Freddie, et cetera, their largest customer may be, money center banks or the largest aggregators out there, but they're forgetting that, for example, some of the largest aggregators are 95 to 98% correspondent, right? And those loans are coming from those independent mortgage bankers. So, some of the pushback on, a lot of different things can also put out of business. Some of need to start to see, more partnerships again. And I don't mean like joint venture partnerships. I mean, what this business is really supposed to be about and liquidity solutions, that's important, I think.
Jen, what is on the mind of servicers coming off that roundtable? I know just being at the TMC conference, talking to a lot of independent mortgage banker friends, like protecting their past customers from, entities that they may have sold servicing to. Really, really top of mind issue for IMB owners. What did you hear in the roundtable that is on service?
Well, yeah, one of the questions that I was asked by the moderator actually was, with some of the acquisitions like by Rocket or Lower, et cetera, of, the Redfins, the Movotos, the Mr. Coopers, et cetera, are we going to end up in a world where we only have a couple of large players in charge of everything? And, one of the things I said was, you got to remember when you combine beasts, for lack of a better way of saying it, super large entities, it takes a lot of time. It also takes a lot of feeds through a pipeline and a system to really have these things communicate efficiently, right? And I think the market, in my opinion, is overreacting a little bit to independent mortgage banks losing their customer. And I also think, Mr. Cooper is a great example. They've got a very large third-party serviced book, right? That they don't own those MSRs, right? And I also think that everybody's talking about that combination, But you also have other combinations that are just as large from a servicing perspective. Great example is the Bayview Guild combination. They've got almost the same level of combined servicing, over a trillion of combined servicing. And I think, you have to think about that. What does that do? When again, the beasts are combining, it gives opportunity to everybody else. Well, they have to figure it out. And I think, again, stop looking at this shiny ball over here, right? Let's, focus on how we're all going to make money. And quite honestly, once we make that money, how we're going to keep it and not give it back. And I think that that's important as well. And, choose the partners that are really partners, right? And, if they're not partners, get new ones, I think is important, whether that's a vendor, an aggregator, a servicer, a lending partner. You got to keep your business going, right? And I think, again, on the GSE front, just to circle back, I think the GSEs need to remember where those biggest clients' loans are generally coming from. And that's not happening today, at least not efficiently or effectively.
This is
Yeah,
the
I wonder if it's intentional or unintentional.
I think a lot of people, yeah, I think, Rob, to answer that, I think a lot of people think it is intentional. If we get rid of the smaller players, then we can just, work with only the bigger guys and make it easier. But again, focus on channels. Those biggest players that they see. I mean, just go read one of, the top whatevers from Scottman's, right? And look at some of the channel breakdowns. I don't think they're paying attention to where the loans are coming from their biggest customers. It could be money
Yeah, it's
center banks that
interesting.
buy loans. It could be all of them.
Recently I was normally I don't write my commentary or any pieces of my commentary months in advance, but I was in this case because I'd gone through some boxes and I found uh, a list of the top originators from 2020 or from 2006. And so I was working on January 2nd, 2026, because it'll be 20 years since the countrywides roamed the earth and the American homes and the GMAX and the
Yep.
option ones and so forth. And so people who think, oh well, United Wholesale or Freedom or Rocket, they're gonna be big forever. Well, when you're talking about a couple $1 trillion market, there is opportunity for a lot of smaller players. And I think anybody who ignores the different levels of production companies is doing so at their own risk. Um,
Well, I also think you have to talk about the volatility in the differentiated assets, right? So when mortgages are originated, it's the mortgage and the right to service. So it's two different assets, right? That mortgage servicing right, as much as it can be accretive and great for a portfolio, it can also take one out, right? If it's not managed effectively and efficiently and candidly priced in reality, right? And of where that value really is. So, how that book is performing is extremely important. And not having that right.
this is
yeah,
the big
I think that the companies that sorry, Rich, I know you want to jump in here, but the the companies who want to add servicing just for the sake of adding servicing, I think are not thinking about that the right way. You should have a good reason why you want to why you want to retain servicing or add to your servicing book. And just to do it just because, oh, our net worth will increase. Well, unless you have some kind of retention program or unless you have a goal, unless you're doing something in your footprint, I think that you're right. It can, servicing can, it starts to run off and suddenly your net worth plummets and
Yep.
liquidity becomes an issue. And the quickest way to end a lender is cut off their liquidity.
Mm-hmm.
It can be problematic.
Huge. Yep. Absolutely agree.
This is the big picture, presented and sponsored by our good friends at Depth for nearly 2 decades, helping fintechs in the mortgage space get noticed and fast. Check them out at depthpr.com or get a hold of Rob or I, and we will get you connected with the fine folks at Depth. So, going back to the GSEs, one anecdotal note, one of the things I do with my consultancy is take lenders through Fannie, Freddie, Ginnie app submissions. I, quite frankly, with I thought it was going to get a lot tougher, here in 2025 with the regime change, but it's actually gotten easier, to be honest with you. So they're making it easier in a couple different ways for small IMBs to get their Fannie Freddie ticket. It's actually happening a little bit quicker. On the flip side, anecdotally, more notes of buyback requests from the GSEs. Jen, I know that is a world that you are familiar with and operate in. Your thoughts on that? What's going on there?
Yeah, I mean, first, I think we should definitely touch upon some of the things we've been hearing, right? And then I'll tell you what we're really seeing because we see all of it, right? Occupancy fraud is out of control. Not true, okay? I think again, what are the details, right? And things to think about. Not everybody pays attention to these. So when somebody takes out a primary residence mortgage GSE, right, their own documents actually in the mortgage, the deed of trust, the occupancy affidavits, if you're using their forms, et cetera, is that you have to move into the property within 60 days of the execution of the deed or trust or mortgage, not the minute that the loan closes, and that you are to reside in that property for 1 year unless extraordinary circumstances occur. And then you are to reach out to your servicer or the people who own the loans, which would be them, but it would be their servicer, and advise. And then they technically can give you a waiver. Okay. So there's a lot of nuance here, right? And I think that that's really important. In the Cook scenario, we actually took apart all of that stuff, right? We had the mortgage docs, we have all of it, right? And again, she never claimed the properties as primary residences. She never attempted to rent them until after at least the 1 year. In one case, multiple years elapsed as well. Without the entire underwriting package, you're not going to know exactly who said what. But I saw, an article about, a vacation home designation on one. But without all of that credit underwriting documentation, nobody's going to know, right? And again, a primary residence is not your primary residence forever. So I think that that's important. And you absolutely are allowed to convert a primary residence to a second home or an investment property and retain it. So I think, again, I think there's a lot more to consider here than just, what do we think it was? So I think that that's important. Claim wise, right? Biggest breach issues right now. Okay. A lot of fluctuating income miscalculation allegations. So make sure your underwriters, if we have lenders on the phone, are really getting their fluctuating income calculations correct. Another rise is MI rescissions as an example, and the basis is that they're using for those. We've seen a rise of a vast array of entities putting back loans for different visa type documentation. And if, in fact, they were going to reside in the country long enough to meet, a 3 year, for example, continuity of income requirement and guidelines, and a vast array of other things. And a lot of guys are forgetting about, there are time period allowances to actually get the documents because, the government doesn't issue you new ones overnight and certain other things, in these guidelines. So again, I think, when you're looking at an appraisal issues, not every C4 property is C5 or C6, but that's the allegation that comes over all the time. 1004Ds for completion, and if there are cracks in the ceiling, it doesn't necessarily mean that mystically there was water there. If the appraiser didn't tell you that there was water there wasn't water there pursuant to guidelines. And, again, there's a lot of complex issues. And if you really don't know how to go back and review these files, or candidly, if you didn't have the documentation to obtain the documentation, you're going to be sitting in a spot where you're either going to be buying back loans or on the GSE front, signing repurchase alternatives, unless you're in the pilot programs. And that's basically the largest guys, right? But 5 points and a 3-year indem. And if the loan goes 120 days delinquent, you're going to be buying it back. Now, let's talk about that for a minute. How many lenders who deliver loans to the GSEs today are paid 105 plus for the loans when they transact, whether they're delivered in the bonds, et cetera? And the answer is none, or mostly none,
Right.
right? So that 5-point repurchase alternative is not even considered versus the price they paid. It's a repurchase alternative fee. So if you end up buying that loan back in the next 36 months at the repurchase price, if you deliver direct, you're going to be paying the real price that was attributed. Okay, still, even with those 5 points, right? If you sold it to an aggregator and they delivered it, they're going to get it back, and then they're going to collect that premium price that they paid to you as well. I mean, and now think about that. Let's say you sold that loan for 102 to an aggregator, they delivered it to the GSEs. You paid 5 points as a repurchase alternative with 36-month indem, and it defaults in year 4, which is in the 3-year history. By the way, the loan already performed for a year before you got the claim, right? And now you're 7 points out of pocket, and lenders are not making that kind of money to originate these loans. So things really have to change here. The other thing is, who owns the large majority of GSE loans? Is it the GSEs?
It's bondholders.
Right. Where is the 5-point repurchase alternative fee going?
It's going to the bondholders.
No, it is not.
It's going
And
to,
that's
oh, it's
something
going to
that
the, it's going to the servicer. Yeah.
no, it's going to the GSEs.
Oh, it's going to
So
the GSE. I should have known that.
that needs to the change as well. If they don't own the risk, they'll tell you that it's because they have, a backstop, which, as you guys know, is not an explicit guarantee. And I thought that was the implicit guarantee from the government, but they'll tell you that why that 5 points is generally being retained is because they need to protect for that backstop, right? But they're not the ones that own that risk. The bondholders are. So, and it takes a lot of reading through a lot of documents to chase this down, right? And maybe it'll change. Maybe it's structured differently in a bond somewhere, et cetera. But generally, that's what it looks like. But I would love to see that change. Again, if you're taking on that risk, you should be the one that, gets that compensation. If in fact, there is an alleged risk that should be there and be dealt with.
But, with them almost assuredly taking them to some modicum of public, I can't see, right? The FHFA doing anything to take anything out of the pocket of things that are going to the GSEs currently. Am I thinking about this right? I mean, they're trying to inflate the value of these companies as much as possible. More repurchase.
Right. But now think about that, Rich, though, right? Let's say they IPO today.
Hmm.
Okay. Let's say they stay the same in the IPO. And let's say they did it a full IPO, not the 5% or whatever, just for a devil's advocate discussion, right? So let's say they did that. And then all of a sudden, they needed to come up with those 5 points and give that money to the bondholder. What do you think the value deviation is going to be from IPO to a year later? It's going to be huge. It's a risky investment. And at the end of the day, you've got guys saying buy sign on these, stocks. And again, the government's generally said 5 to 10% at max. But if you are putting a buy at 25 bucks or 10 bucks or whatnot, depending upon the analyst, why is nobody talking about this stuff? Don't you think that the bondholder deserves to have all of the knowledge, in play? Because the bondholder is going to be the ones that buy the stock too, right? Or, et cetera, and end up owning components of these companies. I mean, look at who owns them today. They're bondholders, they're, fixed income guys, right? And, away from the government. So I think, again, a lot needs to be looked at here. And, consolidation is also a question. And actually, we're going to be putting out a piece about the history of the GSEs, right? Because I think it's really important. There's a reason that there's not one, right? Fannie Mae was, created, I believe it was 1938 off the top of my head, right? Freddie was created in 1970, but there was a reason. And Fannie Mae conventionals didn't exist, right? Until after 1970. Fannie Mae actually was only buying, Govy loans, FHA, VA, et cetera loans and what was called Farm HA back then. It's rural today, right? And nobody pays attention to the fact that Ginnie Mae was originally part of Fannie Mae, right? They were bifurcated, and then they created Freddie Mac. And that's when they started conventional financing, standardized documentation, et cetera. And it was all because of an act and a new regulation that said, we're not going to have a monopoly for this. It's too risky, right? So, and if there's people that don't know all this, we'll have that, document out shortly. And, I hope everybody is going to read that because I think it's very important. I actually hope, and I don't mean this in a obnoxious way, I hope those that have not looked at the history in Washington also absorb that information and think about those impacts, right? The Depression, there was over a 25% delinquency rate. That is why we didn't have a monopoly, right? So there's a lot of real detail here. And, those who know me know that I'm all about the details. So let's look at those details as an industry and, maybe effectuate some change, right? And I think that's extremely important.
Yeah, we've talked about this, Jen, on the show. You can't, Bill Ackman and floats the idea of merging the two, and Donald Trump, tweets something about merging the two, and the NBA and I think smarter minds have said, no, that's not a good idea. We need we need the competition. They have different things going on. The consumer's better off with Fannie Mae and Freddie Mac and not just one entity. So
Yeah, I mean, it's completely contradictory to the fact that they want competition in other places, right? So again, a lot of things going on that really, need to be discussed and, figured out, and discussions need to be had. I agree. And I'm definitely a proponent for keeping two, just to put that out there.
yeah,
Love
me
it.
too.
And a bevy of very nice comments in the chat, praising Jen's insight on the topic, and very, very well done, Jen, and great information for our guests and listeners today. Thank you.
Yeah, no, thanks, guys. I appreciate the positive feedback.
Yeah, and as always, the time flies by here on the big picture, and we are out of it unfortunately today because that was a great convo, and I want to thank all of you for joining us, taking part of your Thursday afternoon out. If you don't watch the live, if you're listening on Pod or YouTube, check out the live show. It's fun. Chat was very interactive today. You can go to chrismancommentary.com to get signed up for the live. And Rob, thank you as always for making the time this week. And I'll see you
Thank
Sunday.
you, Rich.
I'll see you Sunday evening.
Sounds good. Thanks,
And Jen,
Jen. Thanks,
Jen,
Jeff.
thanks again.
Have a good one, guys.
Really
See ya.
appreciate it. And we'll talk to you soon. Have a great rest of the week and weekend, everyone.